I would love to introduce you our first speaker, Professor Krassimir Petrov, and I will give a brief overview of this person who is in front of you, who has flown a lot of miles today to speak here. And first thing I would have to say that he's a senior editor for international US-based financial advisors website financialsense.com. Maybe some of you have read the articles there. He is specialized on raw materials, special metals there, and also this year he has posted a lot of articles there, which we find very interesting here in our company. That's why we thought that we want to share his thoughts here also in Sweden. And I would have to say that the most famous article of his is about Iranian oil bores, and the most well-known fact about this was that nowadays presidential candidate in US, Ron Paul, for Republicans, based his speech in front of Congress on this professor's article about US dollar and its possible collapse. So I think that we will hear some interesting thoughts as the Congress did. So, ladies and gentlemen, I give you Professor Krassimir Petrov. Thank you.
Thank you. Well, Ivar, first, what was the topic? Because last night I was packing together my luggage and said, oh, well, is that what the topic was? I thought that my topic was investment analysis. You had some nice fancy topic, remember? Do you have the schedule? Well, here's the deal. I teach macroeconomics, and in macroeconomics I usually spend like 5-6 lectures on gold. Gold is money. In other words, I teach 5 lectures on money, and within money I extensively teach about gold. In international finance, I usually teach about maybe 3-4 weeks on monetary systems, and most of the international monetary system, the history was based on gold, the gold standard. So in investments course, I also teach a lot about investments, unlike most standard courses in the world, which focus mostly on investing in stocks and bonds, as if these are the only 2 investments in the world. There are, of course, real estate, and as many of you know, real estate has been hot for a while until, of course, it gets cold later. And, of course, there are other investments, commodities. Textbook in investments shockingly has 1 paragraph on commodities. This is absurd, as if people don't eat. Rice has gone up like 100% in 3 or 4 months, but somehow the textbook in investment doesn't even bother to recognize this as a legitimate investment. Of course, oil is mentioned only because it was causing inflation, but again, it's not really a legitimate inflation, and gold altogether is not even considered at all, as if, again, it doesn't exist. So, here is investment analysis, basics, about 1 hour. Occasionally I'll give you, or pause, a chance to ask questions. What does an investment analysis do? Well, number 1, you get a cyclical analysis. Number 2 is fundamental analysis. 3 will be portfolio analysis. 4 is behavioral analysis. And finally, 5, technical analysis. At least what is important for you to understand is that most of the mainstream and most of the standard textbooks usually satisfy themselves with doing a basic fundamental analysis and the occasional portfolio analysis. But of course there are other types of analysis, and I will try to go briefly today as much as I can within 1 hour through all of these 5 to at least provide you a broader view of what the gold market is or looks like. So, first of all, cyclical analysis. Number 1, there have been in history, at least for the 20th century, a number of commodity bull markets. You see the first one has been from 1906 up until 1923. It has been roughly 16-year commodity bull market. Commodity bull market simply means that commodity prices rise and rise steadily. When we say commodities, we mean wheat, agricultural stuff. We mean also iron, copper, zinc, of course gold, silver, energy, crude natural gas, as long as it has been significant in the first period. The next period has been much longer, 21 years, from 1933 all the way through 53. The third one has been from 68 to 82, 15 years. And now the last one has started somewhere in 1999. Some other authors would argue it started in 2000. Still others will argue that it started in 2001. For all practical investment purposes, whether it started in 99 or 2001, it is irrelevant. What is relevant at this point is that looking at all the fundamentals and at least at historical cycles, we would expect it to last anywhere between 15 and 25 years. We can say that now we're in the 6th and 7th year of this commodity bull market. So from here on, you will be having at least another 7, 8, possibly 10 or even more years of commodity bull markets. Well, what is commodity bull market for ordinary people? For them, it's simply inflation. The price of bread goes up, the price of gasoline or diesel, whatever you're using here, LPG goes up, the price of all raw materials go up. So eventually, these prices going higher drive consumer prices higher. Whatever you walk in and pay in the store, that will cost you more. So if you're having a commodity bull market, it implies consumer price inflation, and you better hedge yourself against that inflation somehow, against a different topic altogether. That one of the best hedges when it comes to inflation is certainly gold, but that's a different story. All right, so next one you're seeing here, gold to CRB. CRB is the Commodity Research Bureau Index. These are 15 standard commodities that are traded in the New York exchanges, and these are equally weighted. So they represent a commodity basket, equally weighted commodity basket. And what you're looking here is the ratio of the price of gold to the rest of the commodity in order to see if you're having a commodity cycle, how would typically gold behave in a such cycle. And you're looking here from the beginning of World War I, that will be 1914, all the way to 2000. And what is extremely important to understand is that the ratio has been floating from around half to roughly about 2. And discussions were going, oil prices were going sky high. I say, wait a minute, they're not going up. When measured in gold, they're staying the same. You see, the point is, when you're saying the price goes up, you must always say it goes up against what? Is it against the Swedish currency, or is it against the Turkish lira, right? Or is it against the Zimbabwe dollar, right? Which is, it elicits laughter in the room, but it makes the point. Here the point is that even though commodity prices in a commodity bull markets may go up 10, 15, or easily 20 times higher, it doesn't mean, or when they are considered in gold, they will be going no more than twice higher in gold. And oftentimes, gold will outperform all other commodities. In other words, if all other commodities go up roughly 15 times, gold could easily go up 20 to 25 times. Now this is a gold to CRB ratio, so you can actually see from around 30 to around 32, gold did so much better than all other commodities. Well, that was the period of the Great Depression, so it is natural. It is natural in times of crises that gold does a whole lot better and significantly outperforms all other commodities. Now you see here another rise in 74.5, that's associated with the oil shocks, and another one in 79 through 80. Again, there were major financial fears in 1980, similar situation. So usually gold keeps track with all other commodities, but when times go bad, gold does a whole lot better. So in times of crisis, gold is always the preferred investment in terms of, with respect to all other commodities. Now, in terms of cyclical analysis, questions, let's hear.
Yes, the one before.
Okay.
Where does it stop? 2000?
Yes, this chart has been made and runs all the way to 2000. So now gold is performing more or less on par with all other commodities.
All right. So where would you say it's the...
It's probably roughly...
Yes, but if you take 2008 as we are
okay.
today, where will it be on this?
Roughly, gold has been slightly underperforming. The reason is that in early stages of a commodity bull market, the commodities drive the prices faster first, and then always gold catches up later. In other words, people are buying wheat. 3 billion Chinese and Indians, they're going to be buying wheat and rice no matter what. They're going to be eating. And Eastern Europe and a whole bunch of China and other countries are industrializing. They're going to be buying oil and whatever the price. So consumer demand, industrial demand, let's call it industrialization demand, drives commodity prices higher. So in the early stages of a commodity bull market, the commodities themselves certainly outperform somewhat. In the later stages, gold is distantly outperforming all of them. So if you were to be investing 3 or 5 years ago, a slightly better investment would have been wheat and uranium and possibly crude oil and possibly natural gas. But now that we're in the middle of the cycle, gold becomes the better and the preferred investment, also for other reasons like the credit crunch, financial instability. Banks are, getting in deep trouble. Was it UBS just recorded 20 billion? Are they going to survive? Again, so the questions are, a little bigger when you're trying to invest in gold as opposed to wheat. With wheat, you're trying to just sell at a later time or possibly consume yourself. Gold's got different investment implications. Well, any more questions that we're on the topic? All right. So this is cyclical analysis, gives you the United States Dow Jones Index versus the gold ratio. Essentially, it tells you Dow Jones represents financial assets and how financial assets perform, and gold represents you how real assets perform, that is how commodities perform. And all this is showing you that there are cycles where financial assets distantly outperform commodities and gold, and then there are cycles when gold distantly outperforms financial assets. So when you're starting here in 1920, that's where we begin. It's usually nicer to begin somewhere in 1900s. You have that financial assets with a ratio of 2 went all the way to 20. So from 1921 all the way to 1929, the stock market outperformed the gold market 10 times. If you had invested in the stock market and in gold market, the stock market would beat your gold 10 times. But there's always a but. If you invest in 1929, the ratio from 20 dropped to almost 1. So if you invested in 1929 all the way to 32, gold would have outperformed, well, did outperform the stock market approximately 15 to 18 times. So, for this period, gold was the clear loser, no question about it. Now, from here to here, gold was the ultimate winner. Now, you have the stock market here running up big time, and here stocks are high, gold was low. The ratio began roughly at 1.5, went all the way to 35. So the stock market outperformed gold by 30 times. The stock market was a clear winner. But then what happened? Starting in roughly 66 or so, stocks, all the way the ratio went down to 1. You invested gold here, it would have outperformed stocks 30 times. 30 times. So you put in 1,000 in the one, you put in 1,000 in the other, the one will remain 1,000, the other 1,000 will become 30,000. Now, from 1980 or 1982 was the last cycle where stocks, beginning at a ratio of 1, went all the way to 45. So the stock market outperformed from 82 to 2000, 45 times gold. Well, now gold has been falling and the gold down ratio has been normalizing, but it is still around 20. Well, we can just say what's now Dow Jones is roughly what 12,000, 13,000, and gold is roughly 900. So the ratios now go down to 15. So from here on, if we're expecting this normalization to occur between 1 and 2, you would expect that gold will roughly outperform the stock market from here on anywhere between 10 to 15 times. Is this fairly clear? Does it make sense? To move on? All right, now this is the 1970s commodities boom market. It is counted from 1970 to 1980. The commodity bull market technically began in 1966, as I showed in the first one. But I just want to say, hey, if you just cut off 10 years when commodities perform, which performs best? For that particular 70 through 80, you see that the ultimate performer was oil. Of course, that 1970 cutoff point favored oil. If you had started a little earlier the period, you would have seen that gold would have outperformed all other commodities altogether. So, for then gold gave you, and you can also see the returns. These are annualized returns of 31 and respectively 35%. So gold throughout the 70s gave you an annualized 31% return. That's phenomenal return. Well, it simply went up from $30, $35. Again, it was later on devalued to 42, but roughly from $35 all the way to $850 on January 1980. So from 35 to $850, you can see these were phenomenal returns. Well, gold has already gone up now from 250 to 1,000. So it has already gone up 4 times, but it still has room to go for another 5, 10 to 15. Again, what do we measure it in? Swedish currency or in Turkish lira or in euro? Again, depending on the currency that we measure it against. If we measure it against oil, it's going to go up a little, maybe twice more for the next 10 years. So oil can go up, let's say, 10 times. Gold will go up 15 or so. Any questions here? You can see US coins, silver, stamps, and some other different types of commodities, what their returns were. And ultimately, you can see it's actually very important for you to notice. Right at the very bottom, you have, if you guys can't read at the bottom, the ultimate loser was the stocks, the stock market. They gave you 6.1% return, and because commodities were running at 20%, 6.1% return was significantly below inflation. In other words, if you invested in stocks, you would not have gotten even compensated for inflation, let alone a lot more than that. Then the second distinct loser was bonds. So in a commodity market, in a commodity bull market, it's important to understand that stocks and bonds are the ultimate losers. You don't want to be in those when you have a commodity bull market, because inflation is eating away their value. And I don't want to get into much further than that, but just say that these are the ones that will guarantee you losses.
Don't you think there's quite a good explanation for many of it when you know the history of the finance and investment? Of course you don't invest in bonds when oil prices go up.
Yes, of course.
And you can take the banks now, they have invested a lot in housing and buildings in the US, and people in the US are afraid to buy. They never buy the houses. Because people get insecure.
Yeah. Well again, now you're moving us to the topic of housing booms, housing bubbles, and housing.
An example for why it is.
Yes, it is. Well, that's a general note. You guys, well, it's highly recommended that you learn, study, and understand financial history. It is very unfortunate that most modern investments and finance textbooks don't deal with financial history. Again, I teach my courses quite differently. History is an important component. If you get to understand the history, then the whole picture fits in place a lot easier. You can't just use abstractions and valuation models to understand what's going on. But you get 100 years of history, and it's very easy to see how they float. Stocks go up, gold goes down, then stocks go down, gold goes up, and they move in the opposite direction, meaning they have negative correlation. So history is actually much more important than all financial theory and all valuation models as far as I'm concerned. Now, I more or less gave my short presentation on cyclical analysis. Any other questions on cyclical analysis before I move on to fundamental analysis? Any questions? None. All right, so fundamental analysis, number one is gold is clearly, currently, well, has been and still is undervalued relative to financial assets. Simple as that. The gold Dow ratio is one of these indicators which tells us that gold is underperformed. So now it takes about, 15 ounces of gold to buy 1 unit of Dow Jones Index. When it gets normalized, it will get normalized to 5, but from history we know that it never reaches normal and then plateaus. It always overshoots. It overshoots on the way down, and it always overshoots on the way up. So now we would expect the overshoot to occur roughly to the ratio of 1 to 1. Again, this is speculation based on history, but it's a fairly good argument. Now, so far over the last 5 years, investment demand has been mostly done by smart money. So smart money are investors which are very educated, sophisticated, well-connected, usually have some family investment experience. So parents and grandparents will be bankers and investors. These will be sheiks possibly. They will be some other highly sophisticated investors. They have been accumulating gold over the last, let's say, 5, 6, 7 years. We can state that the gold bull market began in 2001. So for the last 6 years, or from 2001 to 2006, smart money has been accumulating heavily gold. Retail investors and ordinary people didn't even know what gold is. You know, as a famous guy says, Bill Murphy says, people don't know how to spell gold, you know, in 2001. So they were not. Now, since 2007, and there has been a major article in January of 2008, meaning 3 months ago, gold has been finally recognized by big money as a legitimate investment. Big money is called institutional investors. These are pension funds, insurance companies, all sorts of other retirement funds. These are all sorts of major, mainstream, that's the key word, mainstream financial institutions. begin to recognize gold as a legitimate investment. In other words, 3 or 5 years ago, they'll have 0% of gold in their portfolio. Now they say that 5 to 10% of gold in their portfolios is unacceptable as a diversifier. So now all of these big institutions are slowly but steadily beginning to move in the gold market. Now, these are big institutions. They don't and they never jump in. For major financial institutions, fund managers, hedge funds and whatnot, their most important characteristic is herding. You have 5,000 fund managers and you never move away from the herd. So they each invest 1% this year, then they move to 3% next year, then they move to 5% next year. No one wants to veer too far away because if he screws, he's out of job in the next quarter. Say they all do the same thing and they do it slowly and steadily. So they still have another 5, 6 or 7 years to go before they are fully vested in gold, meaning before they feel that they have a comfortable share. Maybe 20%, maybe 30% in their portfolios is gold. Next, inflation hedge. Rising inflationary expectations throughout the world. Well, are you guys here feeling inflation big time? I mean, we feel it in Bulgaria. I know in the United States a massive inflation going on. It's inflation everywhere. So people are beginning to adjust and see that inflation is actually here to stay. And if inflation is here to stay, and if I'm going to be seeing, again, wheat and oil prices keep going up, I'd better do something, meaning I'd better invest and hedge myself. So now, presumably, guys like you are saying, oh, well, I better hedge myself one way or another. You know, even folks like my father is thinking that, well, we got to do something about inflation because it's going to keep, going higher and higher. So there has been a substantial amount of investment demand simply because people perceive quite correctly gold as an inflation hedge, so they've been buying it. Furthermore, there have been substantial amount of currency instabilities. Currencies have become extremely volatile. So a lot of people see that they can hedge their currency risk with gold. Well, why with gold? Why can't we just hedge with euro? Well, euro is falling too. I mean, prices in euro are going up for everything. I mean, gasoline, wheat, food, real estate, whatever you name prices, they're going up. Well, how do we call this? We just call it falling euro, the falling purchasing power of euro. Euro is no good as an inflation hedge. Well, what is a good inflation hedge? Well, Canadian dollar turns out to be falling and not a decent Canadian hedge. Australian dollar turns out not to be very solid. Well, is your Swedish krona doing well? Not really.
Solidly stable.
Stable against what? Against cheese?
No, against euro and Scandinavia.
Okay, so if it is stable against euro, it is perfectly safe, and the correct way is to say it is just as weak as the euro is, because the euro is a weak currency, even though we all think or claim, oh, euro is strong, stable currency. Well, if it's strong and stable, why all prices are rising in terms of euro? All right? Well, it can't be that the euro is stable if all prices are rising in terms of euro. But the point is...
That's because they're all linked to the dollar in some way.
Oh, okay. Well, so then apparently you got dollar problems, and the dollar problems are propagated or transmitted to the problems of other currencies. Well, to other paper currencies. But gold is not a paper currency, and thanks God, governments haven't figured out yet way how to print gold. So gold is still holding its value against all currencies, and I think I'll come to that a little later today. Now, crisis hedge is also known as